Imagine walking into a bank with $1,000 in cash. You deposit it, feeling confident that your money is safe. The bank gives you a receipt, confirming your deposit. But what if I told you that your $1,000 doesn't just sit there? Instead, the bank uses it to create more money, seemingly out of thin air. This is not a conspiracy theory. It is a fundamental part of modern banking known as fractional reserve banking. This system allows banks to lend out money far beyond what they physically hold, shaping economies and influencing financial systems worldwide. But how does this happen? How can banks lend money they don't really have? And what are the consequences of this seemingly magical power? Welcome to Facts from Francis. Today, we unravel the secret of how banks create money, legally, systematically, and powerfully. Stick with me as we dive deep into the mechanics, history, and implications of this hidden force shaping our world. For most people, banks are simple institutions. You deposit your money, and they keep it safe until you need it. This assumption is widespread, but entirely false. Banks are not mere vaults that store your cash until you withdraw it. Instead, they are financial intermediaries that actively use your money to generate more wealth, not just for themselves, but for the entire economy. This system is at the heart of modern finance, yet very few people truly understand how it works. To grasp the reality of banking, we must go back in time, to a period when money wasn't just digital numbers on a screen, but something far more tangible. The origins of banking, from goldsmiths to financial powerhouses. To understand today's banking system, we must first look at the past. Long before modern banks existed, societies needed safe places to store their wealth. In medieval Europe, gold and silver were the primary forms of money, and carrying large amounts of these metals was dangerous due to theft and robbery. This led to the rise of goldsmiths, skilled artisans who worked with precious metals. Since goldsmiths had secure storage facilities for their craft, wealthy individuals and merchants began depositing their gold with them for safekeeping. In exchange, the goldsmiths issued paper receipts, essentially IOUs that could be redeemed for the gold on demand. Over time, people realized they didn't need to withdraw their gold for every transaction. Instead, they could simply exchange the paper receipts. This was an early form of what we now call paper money, money that represents value rather than being valuable itself. But something interesting happened. The goldsmiths noticed that not everyone came to claim their gold at once. Most deposits remained untouched for long periods. Seeing an opportunity, the goldsmiths began lending out some of the gold while keeping only a fraction in reserve to meet occasional withdrawals. This practice was the birth of fractional reserve banking, a system in which banks hold only a portion of their customers' deposits and loan out the rest. This small but crucial innovation allowed money to multiply in ways people had never imagined. Fractional reserve banking, the magic trick of money creation. Modern banks still operate on this principle. However, instead of physical gold, banks now deal mostly with digital money. And instead of individual goldsmiths, we have massive institutions controlling the flow of money in entire economies.
Let's break down how this system works. Imagine you walk into a bank and deposit $1,000 into your savings account. The common assumption is that the bank keeps this money in storage until you decide to withdraw it. But here's the reality. The bank is legally required to keep only a fraction, let's say 10%, of your deposit as reserves. This means that out of your $1,000, only $100 stays in the bank. The remaining $900 is loaned out to another customer, perhaps someone taking out a mortgage, a business loan, or a car loan. That borrower then spends the $900, which eventually gets deposited into another bank. The second bank follows the same process. It keeps 10%, $90, and lends out $810 to yet another customer. This process continues, with each new deposit leading to further lending and money creation. By the time the cycle is complete, the original $1,000 has expanded into nearly $10,000 in the economy. This is how banks create money out of thin air. It is not magic. It is a structured financial mechanism. But the implications of this system are profound. Where does the extra money come from? At this point you might be wondering, if banks are only keeping a fraction of deposits,
aren't they lending out money they don't really have? The answer is yes and no. Technically, the money doesn't exist before it is loaned out. When a bank issues a loan, it doesn't hand out physical cash from its vaults. Instead, it creates a new deposit in the borrower's account. This means that when you take out a loan, the bank isn't giving you someone else's money. It's creating new money in the form of credit. This is why most money in the world today is digital money, not physical currency. The role of central banks, the masters of money creation. If commercial banks can create money this way, doesn't that mean they have unlimited power? Not exactly. There are limits and regulations in place to prevent excessive money creation. This is where central banks come in. Every country has a central bank that controls monetary policy and regulates the banking system. Some of the most well-known central banks include the Federal Reserve in the United States, the European Central Bank for the Eurozone, the Bank of England in the United Kingdom, and the People's Bank of China in China. These institutions control money creation in several ways, setting reserve requirements. They decide how much banks must keep in reserve. A higher reserve requirement means banks can lend less, slowing down money creation. A lower requirement means banks can lend more, increasing money supply. Adjusting interest rates. When central banks lower interest rates, borrowing becomes cheaper, leading to more lending and money creation. When they raise rates, borrowing slows down. Quantitative easing, QE. In times of crisis, central banks create money directly by purchasing government bonds and assets, injecting liquidity into the economy. This happened on a massive scale during the 2008 financial crisis and the COVID-19 pandemic. Central banks are often called the lenders of last resort because they provide emergency funding when commercial banks face liquidity shortages. One of the most fascinating aspects of modern banking is that most money does not exist in physical form. Over 90% of all money in circulation today is purely digital. It exists only as numbers in a bank's database. Think about it. When you check your bank balance, you don't see a pile of cash with your name on it. You see a number on a screen. This number represents a claim on money, but the actual cash isn't sitting in a vault waiting for you to withdraw it. This digital system makes banking more efficient, but it also creates risks. Because banks only keep a small percentage of deposits as cash, they cannot meet all withdrawal requests at once. This is why bank runs, when too many customers try to withdraw their money simultaneously, can cause financial crises. If a bank cannot fulfill withdrawals, it collapses. This is exactly what happened during the Great Depression in 1929 and the 2008 financial crisis, when major banks failed due to liquidity shortages. Fractional reserve banking allows money to multiply, fueling economic growth, but it also comes with risks. Financial crises. If banks lend too aggressively, they create bubbles, like the housing market crash in 2008, which led to a global recession. Inflation. When too much money is created, it can lose value, causing rising prices. Countries like Zimbabwe and Venezuela have experienced hyperinflation where their currencies became worthless. Debt dependency. Because banks create money through lending, economies become heavily dependent on debt. Governments, businesses, and individuals must keep borrowing to keep money circulating. With the rise of cryptocurrencies, decentralized finance, or DeFi, and central bank digital currencies, known as CBDCs, the banking system is evolving. Some experts believe blockchain technology could eliminate the need for traditional banks altogether. However, banks still hold immense power. Their ability to create money continues to shape economies, governments, and our everyday lives. The next time you deposit money in a bank, remember, you're not just storing cash, you're fueling a system that creates and multiplies money, affecting everything from interest rates to inflation. So is banking magic? Not quite, but it is a powerful illusion, one that keeps the modern world running. If you found this explanation fascinating, subscribe to Facts from Francis for more eye-opening content about money, economics, and the hidden forces shaping our world. Until next time, stay curious.